Hey everybody, Maurice Miller here, wealth advisor with Redwood Financial Network. And today, what our topic is going to be is mutual funds. And what I'm going to do is give you a brief overview of how mutual funds work, the good and the bad with mutual funds, as well as some different things that you can do to learn more about mutual funds and how they can fit into your overall financial plan. Now, the reason I chose the topic of mutual funds is this is probably the most common question I get from customers is what is a mutual fund and how does it work? So essentially the title alone gives you what a mutual fund is. A mutual fund is a fund that is a collection of different investors' money. So within that mutual fund, it is literally mutually funded by different investors. So what the mutual fund company does is it pulls customers' money together, and the mutual fund will issue shares to you based on how much you invest in the mutual fund and how much the mutual fund is per share. So the difference between a mutual fund and a stock is direct ownership of whatever company you're buying. So if you own Apple stock, you are part owner of Apple Corporation. The mutual fund itself, the company, is the one that owns the investment. So in this case, Apple stock. So you get shares based on how that mutual fund operates. Now, the reason most people buy mutual funds is for a lot of time they want to take the guessing out of what companies to buy. So the mutual fund company will select the investments for you. Now, with that being said, you don't have any control on what goes in or goes out of the mutual fund. So if the mutual fund company decides to sell off your favorite stock, you can't control that. So that is one of the downsides of the mutual fund. But one of the benefits of owning a mutual fund is that it sometimes gives you access into different markets that you aren't aware of, or it gives you the ability to buy a stock that maybe you couldn't buy on your own. So what I mean by that is if you take a company like Berkshire Hathaway, which is owned by Warren Buffett's company and owned by Warren Buffett. Berkshire Hathaway, their stock for years has traded over $100,000 per share. Now, not too many people walking around can actually afford to put 100 grand in one company, but within that mutual fund, you can then own or have access to Berkshire Hathaway. Another neat thing about mutual funds is that there are ones out there tailored for almost any investor. So if you want to buy companies that only issue stock for banks, you can do that. You can buy financial mutual funds. You can buy mutual funds that will also only buy Chinese stocks. You can buy mutual funds that only buy bonds. And often, when you look at a mutual fund, the title will tell you what that company is buying. So, for instance, if you see a mutual fund that says the Growth Fund of America, that mutual fund is purchasing companies that are focused on growth, but that are based here in America. If you buy a mutual fund that says Small Cap International, well, those are companies that are smaller in size, but are based in the international markets. So what you'll often find is people will construct a portfolio of mutual funds. So what mutual funds also does is it can lower some of the overall risk of investing. Within a mutual fund, you can find anywhere from hundreds to thousands of different companies. So you lower that risk because you're spreading your money out into different areas. Now, on the flip side of if you own one individual stock and that company goes out of business, then, well, that's all your money. Within the mutual fund, all of those companies would have to go out of business at the same time. Now, I'm not saying that's impossible, but it's very unlikely. And if that does happen, we have bigger problems on our hands than just our investment. But another downside to owning a mutual fund is that you have to be more patient with it. Mutual funds can grow, and I've seen them expand rapidly in a matter of a year or two, but you don't always see as quick of growth as you do in individual stocks. But again, you're trading off that risk versus the reward. Also, with mutual funds, they can sometimes have disadvantages on tax situations. Mutual funds sometimes will distribute capital gains. And typically, if you have a stock, you really only see capital gains if you sell it. Well, mutual funds will issue capital gains sometimes, even if you don't sell your shares. So you could end up with some tax burdens from owning them. But again, it's all about what works best for you in your situation. So here's what you do. If you want to learn more about mutual funds, you can directly contact me through either our website or the Facebook page. You can also Google mutual funds. You can go places like Wikipedia. But if you also want to look at how those can benefit you and your family and your overall financial planning goals, then you can like the video, comment, share it, or even post some of your questions. So again, this is Maurice Miller, Redwood Financial Network, and you've just learned a little bit more about mutual funds.